So how does salary sacrifice work? There are two ways in which you can receive, or there's probably many ways. If you're not salary sacrificing, your employer, before they pay you, deducts PAYG tax, so withholding tax. After they've deducted that tax, and depending on how much you're earning, the tax rating, including the Medicare levy, is either 21, 34.5, 39, and 49% if you're earning over $180,000. They'll deduct that tax first from your pay, and then they'll put into your bank account the remaining amount, and you can choose to spend or give that money. You can save the money, or you could put it into your superannuation. So that's if you're not salary sacrificing. If you are salary sacrificing, what happens is, before your employer deducts tax from your salary, they put some money directly prior to the tax directly into your super fund. And on the way into your super fund, tax is deducted. And the rate at which the tax is deducted is 15%, or it could be 30% if your income is over $300,000 per year. And this is where you can see the difference of those tax rates that we saw earlier. If you can pay tax at a lower tax rate, then this is where the saving is. So what happens, your employer directs some of your income firstly to superannuation, then they deduct the withholding tax from your salary, but because it's a lower amount, less tax is deducted. Then the remaining amount is put into your bank account, and again, you can spend it, give it, or save it. And this is where the key difference comes into play. So the salary sacrifice, or the benefit of it, is the difference between what your marginal tax rate is and what you could potentially be paying in superannuation. So if your taxable income is less than $37,000, then your benefit is 6% of what you're going to salary sacrifice. If your marginal tax rate is 34.5%, that is, you're earning between $37,000 and $80,000, then the benefit of what your salary sacrifice is 19% or 19.5%. And if you're thinking about salary sacrificing 10 grand, for example, that means it's nearly $2,000 tax saving just by directing money directly to your super fund. On the 39% tax rate, it's a larger amount of 24%, or on $10,000, $2,400. And if you're on 49% or earning over $180,000, if you're earning under $300,000, other than the benefit is 34%, or $3,400 for every $10,000. The benefit cuts back slightly if you're over $300,000 in earnings, because then the tax rate on the contributions is $30,000. So it drops back then to 19% if you're earning over $300,000. So hopefully that explains how salary sacrifice works and the key benefit of it. And so the key benefit is the difference, or the arbitrage, I guess, between what you can pay by directing your money to super versus what you pay if you receive your money into your bank account.